Hello and welcome to Macrobytes, the economics and politics podcast from Aberdeen. My name is Luke Bartholomew, and today we are kicking off a new two-part series around the economics and financial market implications of Omicron. So in this episode, we'll be talking about the impact of Omicron on China in particular, both because of the size and importance of China itself, but also because the particular strategy that China has used to confront COVID has quite important implications for global supply chains. And so in the second half of this conversation, we'll delve a bit more deeply into those supply chain issues and what they mean for inflation. Then in the next episode of this series, we'll focus on sort of the policy dilemmas that these developments have thrown up for policymakers and how policy is likely to evolve over the next couple of years. But in the meantime, I am delighted to say I am joined today by my colleagues Robert Gilhooly, who is our senior emerging market economist, and Sree Kochugovindan, who is also a senior economist and spent a lot of time thinking about the drivers of inflation. So Bob, starting with you, as I sort of alluded to at the start there, China's had quite a particular strategy when it comes to dealing with COVID, one that sort of makes it stand out from much of the rest of the world now, or at least where much of the rest of the world has got to, this so-called zero COVID strategy. So my first question is just what exactly does zero COVID involve, and how did that strategy evolve over 2021?
I mean, zero COVID kind of, as it implies, it's not necessarily aiming for zero and a complete eradication. I mean, the authorities have come out a bit more recently and kind of specifying they call zero as like a dynamic clearing. So when they identify cases, they kind of do basically everything they can to get cases down to zero so people can go back to kind of living, hopefully, a relatively uninterrupted kind of COVID life. And, take a step back, zero COVID has effectively kept cases, relative to the size of China's population, pretty much around zero since after the initial burst in early 2020. But, it has required, I think, probably more restrictions, particularly, Delta was more transmissible. That required a few more restrictions in 2021 and the second half of 2020. Yeah, I mean, certainly it's not been without its cost, of course. I mean, if we look at the year-on-year GDP growth rates, the headline numbers there, back in Q1 2021, it was one of the highest rates actually ever recorded at 18.3% year-on-year. But the real news there was in the sequential quarter-on-quarter growth rate, which gives a much better sense of how curtailing the Lunar New Year last year led to this kind of near stalling growth. Indeed, that growth number was about 18 percentage points lower, only 0.3%. And of course, Luke, you and I were discussing with Paul Lukashevsky back in December. Quite difficult to disentangle, the COVID shock from other shocks that were hitting the economy. Particularly, we had quite a lot of property sector weakness. That was definitely a factor in the latter half of the year. And I guess also additionally, it's difficult to disentangle kind of how COVID and zero COVID has interacted with the service sector. One might have thought that essentially closing the borders would have boosted domestic tourism, but staycations actually proved to be kind of relatively not that popular. So it could be a sign that maybe it's just the policy dynamics that weren't particularly supportive for kind of households were playing a role there too.
Perfect. So the evidence so far seems to be that Omicron is without a doubt much more transmissible than previous COVID waves, but also much less severe, leading to sort of lower hospitalization rates versus the number of cases. And also those waves seem to pass through extremely quickly, notably in South Africa, the UK, both of which where cases are falling or have fallen quite sharply. And that's allowed these countries to start scaling back restrictions. And, the UK looks set to remove most of its restrictions, at least in England, by the end of January. So given these particular dynamics of Omicron, how it is rather different to, say, the Delta or other previous waves, how is China responding to these specific dynamics?
Yeah, I mean, so far the authorities, I don't think, are taking much comfort from that kind of lower health impact that you've described there. And China's got very high levels of vaccination, over 85%. Many children are vaccinated too. But despite that, authorities do seem to be committed to maintaining the zero COVID strategy. Indeed, we've seen an increasing number of kind of travel restrictions between kind of what are deemed to be higher risk areas ahead of the Lunar New Year, given that kind of risk that large scale migration potentially poses for a more transmissible variant. It does seem to be a bit more maybe targeted than the approach we saw at the kind of the start of last year. So the Winter Olympics is another reason why authorities might not want to change approach in the near term. But beyond that, I think you're really talking about the uncertainty about the efficacy of Chinese vaccines. And of course, the flip side of having successfully held cases around zero is, effectively no exposure amongst the general population too. And this kind of seems like a stronger reason, if you will, that the authorities may well keep going with their current approach. And then, of course, there's also a key political event towards the end of the year. President Xi is widely expected to take this unprecedented third term at the 20th Party Congress. So another potential motivation to keep the zero strategy going over 2022.
So I understand those reasons why zero COVID might be kept in place over 2022, but I guess like taking a slightly longer term view, there is this sense that fundamentally it's not a strategy that can be sustained forever. I'm somewhat reminded of what we call in economics Stein's law. If something cannot go on forever, it will stop. And so I suppose my question is like, how does China ever move past pandemic? What is it that causes this strategy to ultimately stop?
Yeah, no, it's a really good point. And it's very interesting that China seems to have set this exceptionally high bar for itself. But as you say, it's not tenable to hold at zero forever. So kind of how might that change? I think one way could be the authorities looking to roll out kind of more likely domestically made mRNA vaccines or boosters before potentially considering a kind of, I think, probably a gradual shift away from zero. China certainly does have a very large manufacturing capacity. It has shown it can roll out vaccines very quickly too. But even so, I think this could still imply, a significant delay versus other countries. You might be talking in 2022 or even sometime in 2023. And then I guess just aside from the kind of practicalities of vaccination, a lot has just been invested, I think, in the narrative of the importance of zero within China. It's a demonstration the government's handled the crisis better than other countries. So potentially communications could be a challenge. And case numbers and hospitalizations could be high in absolute terms, even if they are able to kind of keep it low relative to population. If Omicron was to be kind of let loose, we could easily be talking about 1 million cases a day in China. Now, obviously, the state does have very powerful communication tools, to put it lightly, and the regulatory shocks in 2021 are an example of how kind of the closed nature of China's political system, tightly controlled public discourse, can result in kind of policy shifts, kind of seemingly kind of coming out of nowhere and surprising there.
So I get the idea that there's this way to open up domestic restrictions gradually, but then there's still the issue of international travel as well, right? And the speed in which China can open up to the rest of the world. So is there a sense in which they're going to be forced to change tactic because of what's going on in the rest of the world? Or, perhaps to put it slightly glibly, do these broader restrictions become something of a new Great Wall, as it were?
Yeah, no, I think that's a good way of framing it. I think border controls are probably going to be one of the last things that really get kind of eased off, given the kind of difficulty of tracking and tracing visitors. I would say China has shown it's got a pretty effective track and trace system. Certainly, the kind of political will to put in large scale lockdowns, but there is this risk that Omicron's higher transmissibility, what seems to be a shorter incubation period, which are just milder symptoms, and kind of possible asymptomatic carriers might make it harder to kind of maintain zero. So you're right, we could get some sort of kind of forced move there. I think this probably implies, though, more frequent restrictions over the course of this year, I think, to be put in place, rather than necessarily being forced to change. But on the other hand, Omicron did just emerge effectively just ahead of Lunar New Year travel period. So there is some risk, I think, that cases start surprising. There's a risk here, I think, that the targeted approach travel restrictions is maybe too reactive rather than kind of proactive. And I think as well, there's some doubt out there about kind of the assertions of COVID being imported by the mail or kind of being coming in on frozen food. Perhaps they're indicating some cracks in the wall, as you put it.
Brilliant. So turning to you then, Sree, I mean, as we were talking about there, the fact that China has this domestic zero COVID policy has quite important implications as to how it relates to the rest of the world, the kind of restrictions that it has, but also in terms of its own economic activity, areas of significant economic production suddenly shutting down. So my question is, what are the global spillovers of China maintaining zero COVID? I mean, how do we go about assessing the risks to global supply chains from this?
Well, I think it's worth maybe starting with a quick review of some of the most important supply constraints that we saw during the pandemic and how they evolved, just to bring a bit of context into this question. So if you remember last year, there were a combination of factors at play. And these were included an increase in consumer demand for goods related to remote working and homeschooling and so on. And there were disruptions across transport networks. Semiconductor production was a key bottleneck, labor shortages, factory outages. This combination led to very severe delays across the global production network and the distribution of goods. Now, the main areas where bottlenecks were most intense were in the supply of key intermediate inputs, such as semiconductors, as I've mentioned, but also major shipping routes. And in particular, there were issues around the US ports, and this increased the cost of freight along shipping routes, particularly from Asia to the west coast of the US. Now, these were issues that were already there at the roots of which were at the beginning of the pandemic, but they were starting to resolve. And then over the late summer, we saw the COVID spread across Asia, starting to derail the recovery across those goods production and distribution networks. Now, in particular, China has, as we all know, a very important role within the global supply chain. And the Delta wave had a knock-on impact in terms of port closures across China, but also factory closures across ASEAN. And some of the key semiconductor producers were hit quite hard during that period. So what we're seeing right now is that there's a risk that a resurgence of these delays as a result of Omicron being so highly transmissible, as you mentioned earlier, and combine that with continued zero tolerance. So this could lead to some renewed delays and intermittent bouts of disruption going forward.
Sure. And it's interesting that you say renewed delays there, because I think I'm right in saying, for as much as sort of these global supply chain issues plagued us for a lot of last year, were an important driver of higher inflation. Sort of by October, November sign, there was sort of early evidence that some of those issues were starting to be resolved. I mean, is that fair to say that the evidence was that things had started to get better before Omicron kicked in?
That is true. That is correct. We were starting to see the signs of the green shoots of recovery were emerging as early as October, November. And we're starting to see that in transport, and some of the measures of freight costs, they're still elevated, but they had declined from the highs that we'd seen during September, October time. And there were a number of measures that had taken place in order to alleviate some of the pressures. And that, for example, across LA ports, there was increased coverage there. They'd shifted to 24/7 coverage to help alleviate some of the congestion. We were also seeing business surveys across many countries starting to improve. Now, some of the key questions there focus on the stocks of finished goods and the stocks of work in progress. And what we saw was that the stocks of finished goods were incredibly low, but there was still some inventories, fairly elevated inventories of work in progress. Now, this signals that the bottlenecks are really hitting those intermediate inputs, and a key example of that would be semiconductors. But that gap had started to narrow, and finished goods inventories had started to pick up. So that was showing that goods were starting to actually flow. And the production of semiconductors had improved, and in turn that led to an increase in production of motor vehicles. So there were a number of different signs of improvement that had begun, but much of this data that we're seeing now refers back to December, November. So it's quite backward looking. So these surveys don't actually reflect the impact of the Omicron wave just yet. So it's old data that we're seeing out of these surveys now.
So if that's old data, and there are good reasons, as you say, to expect, at least in principle, why this new wave would lead to a renewal of some of those constraints and issues that we've seen. But have we actually seen it in the data yet? Are there any signs that this reversal has gone into recovery, any of the sort of the high frequency measures that we track to measure this kind of thing?
Well, it is still very early days. And as you say, we are monitoring some high frequency data. And initially, we are seeing very early evidence of some increased congestion around some of the ports and in China. And in particular, the port of Ningbo, that was where we had a closure back in late summer and led to, which extended some of the delays last year. We've seen that there is an increase in congestion at the port of Ningbo, as well as some of the neighboring ports, including Shanghai. And there are reports that ships have been rerouted in an attempt to try and reduce queuing times. So this isn't enough on its own to signal a continued trend or escalation, but it's definitely something that needs to be monitored quite closely. But then turning to LA and a number of different countries actually across ASEAN, what we're seeing is the impact of absenteeism. As that Omicron wave really starts to take hold, we're seeing some temporary staff shortages starting to delay the production process or delay the the improvements at the ports. So, we were already seeing countries struggling with labor shortages, but against that backdrop, we've seen this extra pressure of absenteeism as the Omicron wave takes hold. And that's particularly a problem in the US, as I said, in those key ports. Now, that's quite important to monitor because that Asia to US shipping route was where we saw the most intense congestion. That's where we saw freight costs were very elevated along that route. And then it could have spillovers across to other routes and impact the global shipping network and the issues with getting containers back onto ships and into other countries and so on. So this could be quite important in terms of the trend going forward and whether those green shoots of recovery are actually sustainable. But it could prove to be temporary, given that one piece of good news is that the Omicron cycle does seem to be running its course quite quickly in some countries, and you can see that across Europe, UK. We saw that some evidence of that in South Africa. So it could be less disruptive this time around. But the key issue, as Bob has mentioned earlier, is the case of China. And with zero tolerance policy, we could see more intermittent bouts of disruption going forward. So that's something we cannot predict, but need to monitor on an ongoing basis.
So bringing this all together, and as I sort of said there previously, that these global supply chain issues were an important driver of the higher inflation last year. I think higher inflation that came surprise to many people and does seem to be somewhat longer lasting than at least we originally expected. So sort of how does these latest developments change our outlook on inflation more generally, and sort of putting all the various drivers of inflation together? How important are these supply chain issues versus all the other issues that we're currently facing?
Yes, there were a number of different issues here. Supply chains were quite important last year. It does we did start seeing one impact was quite famous impact was on used car prices started to become quite elevated as we saw the semiconductor disruptions delaying new car production. So there are signs of feed through into inflation. However, we need to put this into the context of the other drivers of inflation. Energy price pressures are quite important, probably more important at the moment. And this is something that we had highlighted in a series of notes that we wrote last year. But energy prices, we had spoken about the risks of energy price spikes during the Northern Hemisphere winter. And this is likely to continue through Q1, possibly Q2. There are geopolitical risks there. But as we move into the second half of next year, we'll see those energy prices really starting to unwind from inflation. and that will really start to drag headline inflation numbers lower. So even if oil prices remain quite elevated, that what we call the base effects will drag headline inflation figures lower, and that will be quite a powerful driver of inflation through the rest of this year. Supply-demand imbalances are particularly extreme in the US, so it's not just a case of talking about shipping costs and delays in production, but it's also the increased demand in goods that has been part of the story. And we've seen that demand has been quite strong in the US. So we need to look at this in the context of different countries. We may not see the same sort of inflationary pressures across Europe that we're seeing at the moment in the US. So that really sort of leads to the key question of, will it contribute to faster withdrawal of policy support? Because inflation is also a function of the policy outlook. And as we're already seeing, that central banks across different countries have become more hawkish in response to the developments across supply chains, Omicron, and also the demand backdrop as well.
Sree, I think that is a brilliant place to end it, not least because you've done a very good job of setting up our next episode in this series on the policy responses and the kind of trade-offs that policymakers might be facing as a consequence of these dynamics. So we will leave it here this week. So all that remains for me to do is thank Bob and Sree for their excellent insights, and to thank you all for listening, and to remind you to please do subscribe, like, review, rate our podcast on your favoured podcast platform. And we look forward to speaking to you again soon. So thanks very much for listening. Bye-bye.
This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for informational purposes only and should not be considered as an offer, investment recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen. The companies discussed in this podcast have been selected for illustrative purposes only, or to demonstrate our investment management style and not as an investment recommendation or indication of their future performance. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns, return projections, or estimates, and provide no guarantee of future results.